Well, good afternoon and a warm welcome to this afternoon's special webinar on China's property sector and investment climate for China-Hong Kong securities. My name is Sonija and I will be your host and moderator for today. Joining me in today's conversation are Erica Tay, she's Director of Macro Research, and we also have Sonija Lee, who is Hong Kong Portfolio Strategist for Maybank Research. On the 14th of November, China announced that it had plans to basically provide at least about 140 billion US of low-cost financing to the nation's urban village renovation and affordable housing programs. Additionally, what came after that announcement was a slew of media reports pointing to confirmed, as well as draft policy measures that include PBOC allowing banks for the first time to lend to developers for working capital. 2, the existence of a short list of 50 qualifying property developers that may be eligible for financial support. And 3, Guangzhou becoming the first Chinese city to legislate on urban village renovation with just 2/3 approval. This has been reduced from 80% currently. With all of these policies, if fully implemented, it can actually turn out to be material measures to stabilize the property downturn. But now it begs the big question, are they adequate? So to answer this question and more, our panelists will provide a framework to assess China's economy and its stock market. We've also opened a Q&A box to everyone in the audience. So if there are any burning questions that you would like to raise, please list them in the Q&A facility, and I'll do my best to get the panelists to address them. So without further ado, let me first invite my first speaker, Erica, onto the call to help provide some context setting as to why the property sector is so important to China. Erica, hi, welcome to the show. Could you please help us understand this first issue? Let the audience know how we actually got to this point. Erica?
Thanks, Sonija. That's a very important question. I think to understand where China's property sector is heading and where the overall economy is heading, it's important to understand how did the property market get to this bubbly stage in the first place. So in the past 30 years, so taking a very long-term lens, there's 3 unique characteristics about China that cause this real estate bubble to build up. And I think, even though we have seen real estate bubbles in various countries in Southeast Asia, but China's one is a particularly resilient and viral, and there's 3 reasons why, right? So number 1 was that China was undergoing this huge rise in its urbanization rate from about 50% to 60-70%. So in that process, right, when China's economy was developing in the last 30 years, you see millions of villagers migrating to the cities and creating this huge rise in the need for housing demand. So this is what in China they call 刚需, right? So fundamental housing demand. And that demand also led to speculative demand because of a second special characteristic about China, which is that people aren't really allowed to invest money overseas. So each Chinese person is only allowed a maximum of $50,000 investment overseas each year, right? So without the avenues to access foreign capital markets, what they have been doing is treating housing, right, as a fixed deposit. So you see it quite common for regular people to be buying second and third properties, even after they have a place to stay, right? So this on top of housing demand, you see a rush of people buying investment properties. And then the third thing is that local governments, they tend to be short of revenue to spend. So because of the unique tax structure in China, so local governments, that means those in charge of provinces and cities, tend to pad up their income by selling land to developers. So they have an interest in encouraging people to invest in property because that enables them to sell more land to developers and to raise their tax income, right? So all these reasons led to a huge buildup in China's housing bubble, such that so if you look at the screen, we see about 1/4 of China's economy actually linked to real estate. So this is not just the real estate sector proper, but also the upstream manufacturing and services sectors that feed into real estate. So things from cement and steel and glass manufacturing to even banking services, right, and construction services. So 1/4 of China's GDP actually depends on real estate. And then secondly, a second reason why real estate is so important is because, so as we've mentioned, right, so now over 3/4 of Chinese household assets is held in property. So when property prices fall, even though the paper value of the property falls, people feel negative wealth effects. That means they feel their net worth has come down, they feel less rich, and therefore that affects their willingness to go out to spend. So not only does it affect production in China, but also it affects consumption by the man in the street. And then also you can see that the real estate slump actually spills over to Asia's financial markets. So every time you hear news of a developer on the brink of defaulting, you see Asia's financial markets on edge. And beyond financial markets, China also imports a lot of global commodities, right? So countries such as Australia also see their export fortunes tied very closely to China's property market. And one thing that very few people pay attention to is that Chinese local governments, actually some of them, 40% of their annual income comes from selling land and taxing real estate activity. So if this year China's property sales do not grow, China's local governments will actually see a shortfall of about 7 trillion yuan in their incomes. And if property sales fall by 10%, actually their income will fall by 8.6 trillion RMB in 1 year. So that means that these local governments will be struggling to pay for municipal services and to pay for infrastructure that their people need. Back to you,
Erica, could I
Sunil.
just interject here for a second? If you could just reflash that slide and turn it to full screen. There was a client who had requested to see these figures one more time, if that's fine with you.
This one?
Yes.
Yeah, so I believe that our sales folks will be happy to pass on to email these slides to our audience. So yeah, don't worry.
Okay. All right. So it sounds like a lot is at stake over here with the ecosystem so closely interdependent on one another. I guess the next question is basically this, right? One of the interpretations of the central government's policy design is that part of, or perhaps a large part of the 1 trillion financial package will go towards urban renewal schemes. What is the mechanism of this scheme, and how effective has this scheme been in past history?
So I think this scheme is called pledge supplementary lending. So it actually helps a very different universe from the property sector that we have just been talking about. So this actually refers to low cost housing, which helps the poorest of the poor through policy banks. So not the usual state-owned Chinese banks that you see listed, but these are actually arms of the government called policy banks. So the government is likely to get pledged collateral, and in exchange, they will farm out this lending to policy banks to be able to take over some of the uncompleted projects, perhaps from the private sector developers, and sell them cheaply to the low income groups in cities to as social housing. So I think insofar as there is this underserved layer of the society that actually needs the flats, we see that helping to put a bottom to at least the activity in the upstream sectors, right? So as long as the policy banks take over the projects, the housing will get completed. So activity continues, and as a result, you will continue to see the manufacturing sector, that was producing cement and steel, those that were serving the real estate construction activity to continue thriving.
And to give the audience a sense of the impact of schemes like a PSL, when it was first launched in 2014, how much did this scheme help to absorb the excess inventory of the housing market? Could you give us a feel on that, please, Erica?
I think it was quite well received in 2015 to 2019. So if we recall, in 2015, there was a huge stock market crash. So this was one of the ways that the government stepped in to scoop up demand and keep the private sector property developers solvent, right? And that also helped to serve the underserved layer of society. But I think times have changed, and the impact might not be that strong this time. Why do I say that? Because so if you look at the right hand table, you can see that actually demand in the western and northeastern region for property in China has been very weak, and the reason is quite fundamental. So these tend to be where the lower tier cities are, right? So the eastern part of China is actually where the more developed mega cities lie. So what's happening is that in the third and fourth tier cities, we are seeing populations decline because younger people, they are leaving those towns and cities to look for better opportunities in the east, in the mega cities. So with populations declining, that fundamental need for social housing may not be as strong as when the scheme first started 7-8 years ago.
So, in your best guess, assuming that this scheme goes on as planned and goes on smoothly, uh, would you put a figure in terms of how much excess inventory could actually be taken off the market? 10%, 15%, or maybe even more?
Okay, so I think right now we are looking at about 13 trillion RMB per year of just fundamental demand for housing. And there's 3 times that in terms of unsold housing inventory. So 3 years worth of unsold inventory. So I think, if you look at 1 year worth of demand as 13 trillion, I think 1 trillion might help to marginally put a dent in inventory, but I think that will not be the central policy that is going to resolve this real estate slump.
Okay, all right. Looks like there's a long way to go then. Okay, then, Erica, with all of these fiscal measures that we are reading in the media right now, China is expected to run a 3.8% fiscal deficit in 2023. This is slightly higher than the 3% fiscal deficit budget that it started off with at the beginning of the year, right? I think if memory serves me correct, this is also much higher than the fiscal deficit that China ran during the COVID outbreak years of 2020, which stood at probably about 3.7%. Is this deficit of 3.8% a concern for you?
Actually, I think it's widely seen as rather too conservative given China's current macroeconomic situation. So what China is facing right now is actually a shortage of demand. So we see the symptoms showing up in falling prices, especially in falling producer prices. I think the PPI, Producer Price Index, has been contracting for more than a year because of excess capacity and just very lacking demand in several parts of industry. So I think the government really needs to ramp up its spending to put things in perspective. So Seng Yao, you've mentioned about China's fiscal expenditure during COVID. To put things in perspective, right? So we compare China's current targeted fiscal deficit with that of America. So the United States, with growth at 5.2% GDP growth, it is now running a fiscal deficit of an estimated 7% of GDP. So, an economy as running as hot as the US actually has a more proactive fiscal policy than China at the moment, right? So I think a lot of economists within China and also outside of China actually believe that the government needs to step in and raise China's fiscal deficit to at least 5% of GDP. Now, what happened during COVID was that the central government didn't actually spend any of its own money. In all the time that the lockdown was happened, it actually relied on local governments to do the spending. In terms of ensuring public health. Public safety, conducting the testing, and then also building the temporary hospitals and COVID facilities. So I think that is one of the reasons why it looks as if, in 2020, there wasn't much of a dent in the fiscal deficit. But you know what? Maybe let me show you this slide. So during COVID, the local governments actually racked up a lot of spending, related to the measures, and at the same time, the income that they used to get from the property market during the boom years have dried up. So especially provinces in the east, like Zhejiang, Jiangsu, Guangdong, Fujian. So they used to rely on property for about 40 to 60% of their annual income. And with that drying up, and with the spending that they have racked up during the COVID years, they're really in a very difficult position. So we expect not only that the central government should step up its fiscal deficit spending, but to also move more of the local government debt burden onto the central balance sheet. So that will help to relieve some of the strain on the provinces.
Okay, thanks for that, Erica. Erica, this GDP growth outlook for China is looking at 4.4% for next year. I believe this is a number which is also within your forecast range. And we've talked a lot about the spending that and the headroom that the government likely will have to basically hold on to this 4.4% outlook, and that need to probably spend more if they want to get a better outcome in terms of their growth outlook. 4.4% is certainly not a number that is enough to attract the institutional funds flow back. And as we've seen in reports, social media, etc., the confidence level from foreign funds are just not there at this moment. So we have to basically now shift the focus to the consumption side of China's economy. And on that point, it is well publicized that Chinese consumers are saving more, and this is pushing up household savings rate to a very high and alarming rate. What's the consumer psyche behind this phenomena, and what needs to happen first before we can see a material release of excess savings? Erica?
Yes, Xingya. So you're right. Chinese household saving rates are typically higher than in other countries. And one of the reasons is a usual shortage of options in terms of welfare provisions. So I think in much of Chinese society, people are expected to save for their own retirement, right? Including for healthcare. And because of that, I think people tend to put aside a large chunk of their savings, so to save rather than to spend because of this lack of social safety nets. So I think, organizations such as the IMF have actually come out to call upon the Chinese government to better provide a retirement safety nets for the Chinese people. I think that will go a long way in helping reduce their need for precautionary or rainy day savings.
Okay, all right. Before I go on to the next question, I'd like to take this question from the audience. Priscilla has a question that, if this 1 trillion financial package is just not enough for China, what kind of other policies do you think would likely be introduced? Erica, could you take this question?
So in terms of the property market, maybe let's take a look at this slide on the left. So I think the bottom line is that the Chinese government is still determined to keep on its long-term path of shrinking China's huge property bubble, right? So it's really a dangerous bubble, and that has led to property developers taking on quite high risk behavior in terms of leverage. So the government still is on the path of downsizing the property sector. So that is unwavering, and that will not change. It has been going on for at least the last 8 years, right? And then, so you can see from this slide on the left that China used to have housing sales and housing starts at about 100 square meters, 100 million square meters per year. Right, so that is no longer sustainable because actually, as we have explained, China has reached probably the maximum of its urbanization rate, or is close to it. So, when the urbanization rate is so high, you don't get that natural increase in housing demand in urban cities that used to come from villages that were moving there. So as a result, actually the increase in future housing demand will be much slower. So you can see that, and actually in 2022 and 23, China's housing sales have come down to about 100 million square meters a year. So that is probably where you find things, where you find demand closer to supply, right? We're not getting back to the good old years when China was selling and building 200 million square meters of housing anymore. So I think this is a new reality that the government is moving everyone towards. Now, the question is, will it, on the way, the long-term path to bringing down this housing bubble, will there be accidents, right? Will there be mishaps where, maybe some bank that was too exposed to certain developer goes into trouble, right? So I think that is what the recent policies are about. It is really to prevent disorderly accidents from happening and spreading contagion to other parts of the financial system. But I think overall, we are not holding our breath for property sector to come back even in the long term.
Yes. It's an interesting point, Erica, and let me just dive into this related question. China recently opened criminal investigations into Zhongji, which is a very significant shadow banking player in China. What had happened was that the company revealed a shortfall of 36 billion, I believe, US dollars in its balance sheet. Is this the canary in a coal mine, Erica?
I guess what you're asking is on two levels, right? So at the micro level, is 中值 a sign of more wealth management or shadow bank failures to come? I don't think so, because Sonija, as you have pointed out, 中值 actually is suspected of engaging in fraudulent behavior, right? So the employees and the management have been arrested this week. And investigations are underway. So I think it's not so much due to any of the idiosyncrasies in China's financial or property sector, but it's very specific to criminal wrongdoing by people running this company. But I guess zooming out to a higher level, I guess your broader concern is whether China's shadow banking sector is going to jeopardize the wider economy. I don't think so. So the government has actually done a very good job in the last 8 years, 8 to 10 years, in shrinking the size of the shadow banking sector. So it used to be about 15% of the financial sector, but now, after a lot of regulatory steps were introduced, shadow banking now constitutes less than 5% of total lending. So I think, even if we see some of these high risk behaviors flaring up, from time to time, and some investors getting burned, but we don't expect that to destabilize the wider financial system nor the economy.
That's assuring to hear, Erica. Thanks for that. Let's address one more question before I turn the rostrum over to Sonija on the market outlook. On exports, on China's export market, the jury's still out whether 2024 is going to be a year of soft landing for the developed markets, and the impact in terms of how well or how poorly China does in terms of its export sector will largely be affected by that. Assuming we get a soft landing, which export sector do you, in your opinion and with your data sets, what have you seen where trends have improved, and which export sector has actually flawed in your opinion? Could you give us some color on that, please, Erica?
So for exports, I think all of us in Asia have been feeling this disconnect between a very strong US growth and very weak or even shrinking exports in ASEAN as well as China. So what's been happening is that, since a reopening from COVID, actually the developed markets have been growing strongly, but driven by this revenge spending on very specific services, right? So people were not able to indulge in dining and travel and flying during COVID. And so I think during the past 18 months, that's what we've been seeing. But the good news is that we actually, in the last 2 months, we have been seeing signs that the developed markets have switched from this revenge spending on services. So they've done their traveling, right? Is out of their system, and they're switching back to spending on goods again. So that's very good news for Asian factories as a whole, right? And at the same time, we see that there's this electronics replacement cycle that's going to happen. So usually people tend to buy gadgets, and then that will last them for 1 to 2 years. So we see that people are starting to need to upgrade their gadgets again. So that's another good sign. For China's exports specifically, I think one very bright spot we see is in cars. So China has been rivaling even Japanese and European manufacturers in terms of exporting cars to the world this year. Because primarily it was driven by electric vehicle sales, but China's sales of traditional combustion engine cars are actually also growing very strongly and are penetrating global markets because of their just competitive price points. So we continue to see very, very strong growth on that front for China's exports.
Great, that's really assuring. Thanks, Erica. Okay, I'm going to basically shift the focus to market strategy right now, and I'd like to invite Sonija onto the stage. So Sonija, the audience may or may not know that the CSI 300 index is basically down 18% year to date. The property sector, after the release of a barrage of news on financial package and aids, it has reacted somewhat last week, but a lot of the gains have also been given back this week. Sonija, when you look at the market and whatever is going on at this moment, can you provide us with a simple framework to analyze not just the property sector, but also but also on the stock market from your perspective? Sonija?
Okay, thanks for having me today. And I have a chance to speak on the China property as well as the investment strategy under the recent, somehow it's a weak market. And I think the reason, let me share some screen first.
Sonija, could you also turn your PowerPoint presentation to presentation mode, please, so that we can get an expanded view? Thank you.
Okay, sure. I think this is the presentation mode. Okay, actually market is really weak today. And we see that yesterday actually reached to year-to-date lowest level. And the major reason for the weakness and actually, for the Hang Seng Index, not only this year, but last year, we have already suffered from the COVID and the lockdown in China. This year, although we have excitement before at the beginning of this year because of the easing in the lockdown in China. So we hope that for the reopening of China can give up some hope for the economic growth. But unfortunately, the market, the focus shift to the China property sector. So at the beginning of the seminar, I would like to focusing more on the property sector first, and followed by what's are we now, and the Hang Seng Index I will using for the technical and also for the valuation, to give an outlook to you guys that where are we and where should the index will go in the future. And so for the property sector, actually now it's so many news, and especially for last week. And this is the news that I extract from the Standard and or from the Bloomberg. They're mentioning something like for the Chinese government or the regulator, they really want to do something and helping to give some financial support to the China property sector. And this is the actually these are rumors only, but the details I will also describe in the later slide. And for this slide, actually, we do see actual movement in some policy, because for the financial support, and as I mentioned, this is rumors, but this is not confirmed yet. But this is the real movement from the local government, especially for the tier 1 city. As Erica also mentioned that actually for the China property transactions, especially in the eastern part of China, actually they perform relatively well because of the job opportunity and also for the population shift from some tier 3, 4 city to the tier 1. So we saw that for the tier 1 city, there's some easing policy, which is giving market surprise. For these two, and for the first Guangzhou, they eased for their mortgage some policy, especially for the second home mortgage. And what we see last week is another one, is Shenzhen. Shenzhen also released for the home buying restrictions to push for the demand. And so we believe that these two move is expected to encourage for the home upgrade and push for the demand, and also save, and also some sales for larger for some people want to have a larger home. So, and also actually market believe that maybe Beijing and also for Shanghai will follow to further boost for the China property market. And so this is what we really see for the local government to support for the overall property sector nowadays. And go back to the financing issue. So we saw that actually for some developers have their difficulty in getting some financial support. So we can see that for the Chinese government, for the authority, they really do lots of effort to help to do the financing support. This is the details of the right list, although this is not confirmed yet. But what we see from the from some media, for example, this is from the Reuters, and they mentioned that for the Chinese regulator, drafting for a white list of 15 developers that entitled for a range of financing, including for the loan bank and the bonds and also equities. And actually the list is quite surprised, because they have already some company on the list. For example, the POE, the Country Garden, the Sino Ocean, and also for the seafood. And because for the period, although we saw so many financing support from the government, but actually they don't have a list. So why this news, although this is not confirmed yet, but after this news come out, the China property sector really have a very positive reaction. And for this one, and also not confirmed, is our own rumors only. This is a last word according to the Bloomberg. They are saying that Chinese government actually have a fraud on the unsecured loan to the developer. And of course, this loan is only for the working capital. So this is not helping them to release for their default risk, but to ensure that they will have a home delivery. And so until now, and not only me, but also the market have discussed with the bank, and they actually, none of the bank saying that they receiving this instruction from the regulator, and some even deny of this, and some say that they are already study for the potential import, and but if this really happened and confirmed, actually there will be a big change, no matter to the property sector and also for the banking sector as well. And let's go back to the property sector, because we saw there's so many policy that so many rumors, actually they are really want to help for the property sector. So we give us that several scenario. So if the scenario that for the whitelist or really for the unsecured loan really confirmed, and we do believe that it will help for the SOE developer and also for the quality POE developer. Although some news saying that this is the bank will allow some unsecured loan to all the property, but we don't think this is possible because bank also have to evaluate for their risk and to handle for their asset quality, etc. And so that if that really take effective, it may require selective list. And also we think the government is likely to set some KPI for some banks to follow. And also, even if there is a liquidity support to the developer, it may also restrict it to the ensuring for the home delivery only. And also that may also request some collateral too. And so that we think for the SOE, of course, for their financial status actually is relatively stable compared with the POE. And also actually, even nowadays, they got financing from the bank is relatively easy. So if there really a further financial support from the bank or from the local government, we do believe that it will only help them to enhance their funding costs further, and so that really, of course, help them. And for the quality POE developer, of course, we also think that they will also will benefit, because they at least get some funding support so that they can try to get their project commission. But for the one that have already have some financial distress POE, and we don't think the bank will offer additional funding support, although it is possible for them to have some certain support at some project level. So for example, the unfinished home that may really help. But overall speaking, we believe that some sort of guarantee or collateral is needed with such project level loan. So we highlight that several companies that we can watch for, and quality name, of course, because the market is so weak. So we highlight the SOE will be the Coley and CLM. And for the loan distress POE developer, we will only highlight the loan for, because for some rumors, actually loan for S will be on the list. And this is for the one that in the tier 1 city exposure, as we highlight that actually from the local government point of view, some of them, Guangzhou and Shenzhen, already easing for the second home buyer mortgage down payment ratio. So that we believe that it may help to push for the tier 1 city transaction in the futures. So we can also look for the one that have some relatively high exposure to the tier 1 city. So we could like to mentioning about for the Yueshou, and also actually the one that we highlight, Coley and Xiaolan, also get a relatively high exposure in tier 1 city too. So this will be the also we do not suggest to chasing in for the distressed developer, as we think that for the near term share price may maybe they have some excitement too, but will be very short-lived. And so this one is for the pair trade idea, but this is only we think that for the policy move, because now it's only speculated and not confirmed yet at the current stage. So if they really confirmed and the bank have to force to make some unsecured loan to all the developer, this is the pair trade that we recommend the investors. So stop the bank because they have a very high risk in their credit risk and also for the national services risk, and to loan for the property. But it is only recommend once all the whitelist and also unsecured loan is confirmed. And actually, this is a quite interesting slide that I want to highlight to the investor, is that actually under for the current guidance, actually bank are not really allowed to lend the onshore unsecured loan to the developer. And so that most of the developer loans are subject to the financial loan have to collateral by the underlying asset amount. And so you can see that why we can see that for the first half this year, the bank, the non-performing ratio is still very relatively low. It's around 4.5% on average on the onshore bank developer loan book. And we actually see that for the right list or for the unsecured loan, this is not the first financial support rumors in the market. But we saw that actually last year, and in the November last year, and actually, though the Chinese government, they have already implemented for the 16-point measure. It's something like also a list to provide the liquidity support to the developer, including the bonds, trust financing, special loan for the project commission. But we do see that for the developer loan in the total loan mix in the China bank actually reduced. From last year, it's around 5.9%. But in the first half this year, it's dropped to 5.7%. And also on the absolute value, we can see that on the left-hand side, and for the half year over half year, the growth actually is zero. So you can see that from the SOE bank, Big Four bank, for their developer loan growth rate actually record positive growth. But for some smaller banks, actually they record decline. So we saw that actually for the Chinese government on the top of the policy will, actually they encourage for the banks to borrow, but actually not much bank willing to borrow after they assess for the asset quality, and also if those companies don't have the collateral, actually they do not want to borrow too. And so this is what we want to highlight, is that in the futures, not only we have to see whether there's a further confirm on the financing support to the for the property developer, but we also have to see the details whether they really have to force the bank to borrow or not. So this is all the details that we have to look for. So go back to the Hang Seng Index. There will be a several slides more to highlight. And one is for the technical view. And our technical analysts and analysts have published their report this month. And we highlight that actually for the Hang Seng Index is about to the end of the down cycle. And we believe a little a new upcycle is about to unfold. And this is because we take reference from the RSI and also for the DPO technical indicator. We believe that the momentum compression, the phase will end very soon. And we said the Hang Seng Index resistance level will be at 20,280 points. And if the reversion side happens, so if the index really fall again, we believe the first technical supportive level will be at 16,500.
Okay.
And this is for the valuation. And this graph actually is showing for the last 4 years for the Hang Seng Index for PE ratio. So we can see that once the Hang Seng Index for PE ratio reach around 8 times for PE, they got a quite strong rebound upward momentum. And we can see that for the beginning of the 2020, this is the outbreak of the COVID in China and also in the global, and also near for the October 2022. This is for the lockdown news in China, and also we also wisdom some protests in China too. So the Hang Seng Index and also for the China Index actually dropped a lot at that level. And now actually we are already reached to our valuations about 8 times or around about 8.2 times. So we believe that the valuations is near on the low bound of that range, and also we can view that this is undemanding valuations. But some of you may argue that although the valuation now is low, but if the corporate earnings started to fall, maybe even 8 times for PE may not justify for the valuations. So here is another slide for the MSCI ASEAN 2024 earnings revision. We saw that Hong Kong, MSCI Hong Kong is the one that I highlight in the yellow color. So actually for the MSCI Hong Kong, next year the earnings growth is for the MSCI should experience around 17% year-on-year growth for next year. So given that for next year, we still have a double-digit earnings growth versus for the valuation nowadays is only 8 times. So we believe that the current valuation is already low enough to justify for the valuation.
Okay. Well, it's interesting to note that even if we look at MSCI China, it's double-digit compared to MSCI ASEAN, which is expected to grow by only 7% next year. Sonija, I think this is a great time for me to bring in a question from the audience. So Mr. Ang basically has a question on smart money and basically what are the major themes to look at. Specifically, he's asking if investors are already exposed, already have in fact, no exposure to the Hong Kong tech names. Are there any specific tech companies in mind to monitor? His follow-up question is this: if you have no positions in Hong Kong, then what are if you already have existing positions in say Hong Kong securities, then what are some of the sectors and names to basically avoid, and some of the names to basically keep? Could you take this, please, Sonija?
Oh, okay. Actually, the question is what I'm going to highlight in the following slide. Let me show you this. And maybe I can also talk about our strategy recommend to the investor, because we highlight that, for next year, and we will undergo 2 main themes. One is for the US Fed Fund rate. Our houses forecast there will be a cut and around 75 basis point cut in the 2024. So that we believe that it will also benefit to the tech valuations too. So that under this frame, I will also recommend 2 tech companies that are for the investor. Another one that I can mention later. So I want to go through this first. It's the NetEase. And NetEase is although we know that for next year there will be potentially a Fed fund rate cut, and also not only for our houses, but the consensus also forecast there will be a Fed fund rate reduction in the 2024, and so that. And as I mentioned, there will be a help for the valuation in the tech company, and for the not only for this, but we also have to look for some quality name. So we have to find out which company have still have an earnings forecast, and also maybe have some margin expansion. So we highlight two names. One is for the NetEase, and one is for the Xiaomi. And for the NetEase, we believe that this company can benefit from 3 points. One is for the solid 2024 online game pipeline, because they have as they expected that there will be several games that will be launched next year. For example, for the Condor Hero, Where We Meet, and also for the Mission Zero, etc. So that they will be excited. Market is exciting about for the pipeline growth. And also we see that for the NetEase, and especially for the first Q result, and we saw that there is a margin exposure, and the expansion was due to the company have more self-developed game. So that, and if the portion of this self-developed game getting higher, the margin of for the online game actually will be increased too. So we believe that for the NetEase, they mentioned that they are applying for the AI across the game developing, and so that they have already saw a very good improvement in the productivities, and also replacing manual work already. So we believe that for the NetEase will benefit from the online game expansion, and also for the Q and for the margin expansion too. And also valuation wise on the online game payers, NetEase now is trading around 18 times of our PE ratio. If we compare with Tencent, and Tencent actually trading more than 20 times. So valuation wise actually is triple too. So we have a positive on the NetEase. And for the Xiaomi, and we saw that Xiaomi actually benefits from the global smartphone shipment improvement. So according to the counterpoint, and for the global smartphone sell-through rate actually grew by 5% year-on-year last month, which is the first month recording positive growth in the past 27 months. So that we saw that for the global consumer, they started to maybe upgrade their existing smartphone. The trend is forming, and also we saw that for the smartphone shipment in China, record positive growth too, and so that we believe Xiaomi will benefit from this trend, and also Xiaomi have another positive is that one is for the margin expansion too, because we saw that for the Xiaomi, if you have, so I don't know whether you are you buy the Xiaomi before. Previously Xiaomi, their smartphone is only around maybe 2,000 or below for one smartphone, but now actually after their features upgrade, and the ASP for the Xiaomi actually the price is higher too. Now it's around 4,000 to 5,000 RMB for the Xiaomi 14, so that we believe that the premiumization of the Xiaomi series will help for the Xiaomi not only to increase for the market share, but also for the profitability, and so that we believe Xiaomi will benefit from this premiumization trend too, and so that we want to highlight these two names on the 10 name.
Thanks, Sonija. Sonija, I'm mindful of the time. There are many more questions here, so we will likely go over time for 10 minutes so that we can clear some of these important questions from the floor. The next question that I have is from Mr. Omar Shatri, and I believe this is a question for Erica. The question is, what is the likelihood of China removing the $50,000 US investment limit abroad. Erica, could you take this, please?
Thanks. That's a very good question. So I think as we have shared at the start of this session, actually one of the root causes of China's property bubble ballooning was actually because of Chinese households unable to invest in financial assets overseas, right? So actually to take that froth out of the housing bubble, it's quite important to give them more outlets to access diversified global investments. Unfortunately, the signals that we have gotten recently from the People's Bank of China that controls these capital inflows and outflows is that the stance towards allowing residents to invest overseas is probably going to turn more conservative. Why do we say that? Because at this recent financial work conference that sets the regulatory agenda, and this conference that happens once every 5 years, the government actually came out to remove this line from its agenda. So previously, 5 years ago, the line was that to steadily move towards capital account convertibility. So quite simply, it means China was aiming to free up capital flows between onshore and offshore eventually, right? So that line was taken out of the most recent work conference. And so this means that actually we think China is no longer aiming to open up two-way flows, especially for its residents. And we can see why, if I may share this screen.
Sonia, could you close your deck, please?
Oh, okay, sure.
Yep. So this pretty much explains why China's central bank has become more conservative in terms of allowing resident investments overseas. So in the third quarter, China actually saw first net capital outflows in 3.5 years. And if you take out that little aberration during COVID, first quarter of 2020, actually it was the first net capital outflow in 8 years, right? So this was partly due to China's FDI, so the foreign direct investments turning negative for the first time on record as foreign investors start to look elsewhere for their Asian capacity or plant expansions, right? So FDI, we expect it to continue to stay weak in the coming year. And with that, I think China is quite worried of the impact of the capital outflows on its exchange rate. So we don't expect China to loosen and allow residents to invest more than previously.
Okay. Erica, I'm going to keep you there for one more question. And this is coming from Mr. Satya Mohan. He's asking, a lot of people are now comparing what is happening in China with Japan in the 90s. Do you think this comparison is fair, or do you think it's different?
I think China is a bit different from Japan's situation in the 90s because if we recall, Japan had this huge run up in property prices, right? And that was that led to this huge overhang after that of people unwilling to borrow because they were sitting on very high debt burdens with falling assets, right? And then banks were also unwilling to lend because they were sitting on a mountain of bad loans, right? So I think in China's case, the system, especially the political system, is quite different. So we think the banks, because banks in China are still mostly state-owned banks, so we expect them to still be willing and be expected to lend to the sectors in order to keep growth going. In fact, as Sonija shared, the banks have been already taking on what we call national service burdens to continue lending. So we think that that is a key difference between China now and Japan in the 90s. So we think credit will continue to keep flowing at quite a healthy rate.
Thanks, Erica. Sonija, I'm going to come back to you. There's a question from Mr. Danny Tam, and it's a question on long four. Moody's recently downgraded long four's credit rating to non-investment grade. Can you comment on this development and whether this is an indication that long four may be facing liquidity issues in the near future? Sonija?
Okay, and because I think for the Moody's, the report or why the company downgrade for the long for credit rating, which reflecting several expectation. One is for the decline in the contract sales, another is the decline in the earnings, and also for the difficulties in getting the financing support and from different kind of tools, for example, for the bank loan, for the bonds, and also for the equities. I think this is well known by the market. But I want to point out that is for the long for, actually for the first half results, we can see that they are really very a very decent growth, but actually they record a quite relatively stable result compared with the other developer. And what I mentioned is that for the loan for example, for the gearing ratio for the first half is around 15.7%, which is lower than for the peers average. And also for the revenue for the loan for, of course, it record decline is around 35%, but for the bottom line is only down around low single digit. And so I think for the Moody's report, actually they point out from what difficulty that for the developer are facing. So they comment on the general situation in China property sector. But for the company-wise, for the long for, I think fundamentals still remain relatively solid. And also, I found that for the long for, they forecast for the contract sales for this year. Of course, they forecast a decline, but it's relatively positive. It's only declined by 10%. So also outperform for the industry average. And so I think for the long for at the current stage, is still safe. It's a quite safe payers in the property sector.
Okay, great, Sonija. There's a last question that we'll take from the floor, and I'd like to invite Erica to take this because, Erica, you and I have had this discussion on the China EV market just a few days ago, so this is probably your area of expertise. The question from Leonard is, what is your take on the China EV market, both domestic as well as its export market potential? Erica?
Thanks for the question. Yeah, so I think this is one area that we have been looking into as well. So as you know, China's electric vehicle brands have been taking the world by storm. And that in the last 6 months has led to a very strong pushback from other brands around the world, right? I think we've heard that the Europeans are actually trying to put up some trade barriers against Chinese EV brands because they are starting to muscle into the European car makers' market share. So you notice that the keyword I'm using is brands, right? So you can prevent Chinese EV brands, through some sort of trade, sanctions, perhaps, or some trade barriers, but you can't actually prevent Chinese EV technology. So let me explain why with this slide. So if we know in the 20 years ago, China had this had to allow brands such as Volkswagen and General Motors to enter and sell cars into the mainland market, right? Because in return, these American brands and European brands actually promised to set up plants, right, and transfer some of that technology, some car making technology to the Chinese, right? So to teach the Chinese how to make cars, right? So, but in recent months, what we see is the reverse taking place, right? So brands like Mercedes-Benz, Audi, Volkswagen, Toyota, and Honda are actually lacking Chinese electric vehicle technology and battery technology, and they are actually opening up their home markets in Europe and Japan to allow Chinese battery technology to be embedded in their own Mercedes branded vehicle, right? And a Toyota branded vehicle. So actually you might not see the Chinese brand on the car that's being sold in the Japanese and European market. It might be sold as a Mercedes and Audi, but actually the battery technology inside is provided by a joint venture through a joint venture by Chinese companies such as BYD, right, which Warren Buffett has a stake in, SAIC, Shanghai Auto, XPeng, and other Chinese brands. So we see this sort of a Trojan horse approach, in getting around the trade barriers against Chinese EV brands. We think this might enable Chinese EV companies to be able to protect their global market share going forward.
Great stuff. Let me ask a final question, and it's actually a personal poll. Erica, you are Singaporean. We are spoiled for choices in terms of automobile makes here in Singapore. Would you buy a BYD yourself?
Would I buy a BYD? I think well, I mean, first things first, I can't drive, so that kind of it's a non-starter. I think I would be very interested in exploring Chinese EV technology otherwise, because I think clean energy vehicles is actually the way to go, and I think that Singapore is also rising to the challenge in trying to reduce emissions. So I think even taking out non-drivers like me, I think the future is quite bright for electric vehicles.
Super. Okay, we've gone near 15 minutes beyond the hour, so I think it's time for us to draw this presentation to a close. I'd like to first thank the audience for your great support in supporting us for this lunch presentation today. We had a bit of IT glitch yesterday, and we do apologize to some of you who tried to log in but were unable to. The point to note here is that we do look forward to conducting more of these seminars to bring you more investment ideas, whether it's this market or other ASEAN markets. All of the slides that you saw this afternoon will be available to you. We'll be sending the PowerPoint PDF in PDF format to your sales reps, and they'll be distributing it to you on our behalf. If there are any further burning questions that you have, please also send them through your trading reps, and we'd be delighted to basically get them addressed and send them back to you. So with that, I'd like to thank the panelists for their time today. Thank you to all of our value clients once more. And we do look forward to seeing everyone again in the near future. Thank you very much.
Thanks, everyone. Bye.
Bye-bye.